We are going to be covering, of course, the FOMC meeting with Chair Powell. He'll do a whole run-up. Welcome back into the show. If you have not subscribed to the channel, do that right now, guys. Just hit the subscribe button, and hopefully you guys are already a subscriber and part of the PBN community. And hit the little bell as well. You get notified of things like this, so in the future when we go live, you'll get a notification from YouTube, and boom, you'll be in there. I do want to thank our sponsor, and that is I Trust Capital. You guys can get into long-term holding of your crypto, and you can do it in an IRA. If you're not in an IRA right now, this is a great, not financial advice, but it is a great tool for long-term wealth building because it is tax-free. This is one of the best tools out there. Go out there and explore I Trust Capital. You can get into crypto, silver, gold, all sorts of altcoins. You can kind of see the ticker there. Everything you can imagine is available over there to invest in. You get to manage your own trades over there as well. So very easy to do. All right, let's get into it today. We will be going live with Chair Powell here. Around 2:30 is when sometimes he comes a little early, but around 2:30, we'll get into it. And the way it works is he comes out, and we'll get the notification here in a minute on whether we get a rate cut or not. Yeah, is it in? Okay, so all right, so anticipated the 25 basis points are in on the rate cut, so we know that. What happens after this Board of Governors meets is the final addressing to the reporter gaggle. Now, the reporter gaggle is where we get a lot of Q&A from Chair Powell. Now, this is typically where he starts to reveal the forward-looking statements, the potential for quantitative easing, and maybe even what could be occurring in the next FOMC meeting, which is in December. So now we've got 2 basis point cuts this year. The anticipation, of course, is that 3, and it most likely will be the case. The real question is, now with all these jobs numbers that are playing into this, could this shift his narrative? So Nestle plus 7 more companies have announced massive job cuts just in the last 10 months. And this gets into a whole slew. Nestle is a big company in the ag space and in the large food space, both on retail and also on the food service sector. So that really starts to get into a big cut if we're starting to see layoffs in this area, 16,000. And I can't imagine that this company is in a position where they can start to integrate AI. I think this is because they themselves are in a little bit more of a struggle. Within that, you had Amazon coming in, 15% of their job roles in departments, including human resources, tech team, consumer business, among others. That's 14,000. I think it was 14,000 jobs. Google is coming on. They laid off some of their early roles, and then Accenture also laying off another 11,000. I mean, these numbers are crazy. 4,000 coming in from Salesforce, Microsoft even coming in at 2,000. And this is 15,000 employees and then around 2,000 more staff that were underperformers. So 17,000 basically that are out. So this gets into a real effect on the economy. And this is what I think the Fed has to be concerned with, more so than anything, is to lose the grasp on jobs. They have 2 mandates, of course, and one, of course, is understanding inflation and maintaining it. The other is making sure that the job narrative stays positive in the United States, because if we get into both rising inflation and the loss of jobs, we have stagflation going forward to all of that. If you look at Trueflation over here, it's holding at about 2.44%. Notice this right here, guys. Government data blackout. 28 days, 13 hours, and 57 minutes and counting. Look at the Challenger job cut data. Down 37%. U.S. government domestic product down 28%. And then new residential home sales starting to climb up. So maybe there's something brewing here when you look at Trueflation. If you look at the indexes themselves, just to give you a quick view, the stabilization around 2 to 2.5 is there. However, if you go to this dip right here, which was August 3rd, that was the lowest we had seen here, at least in the recent months, at 1.61%. It has been climbing since then, so this is the concern that the Fed has. Do we have a control on inflation? Now, one thing that you have to remember with the Fed is that they have reposited their idea of where inflation neutral is. In the past, it's always been 2%. The Fed and even Chair Powell said this in the last Fed meeting, which was huge, and that is that we could be recommending a 3% or closer to a 3% inflation. That would be absolutely destructive for the American economy, I believe, because that does start to raise prices across the board on almost every asset and everything out there. As I said, if you just joined, make sure and hit the like button on this video and subscribe to the show. We will be doing a live airing of the FOMC press conference. That, of course, is where Chair Powell will address his forward-looking statements, how we look into the next FOMC. I think more importantly is how he's looking at both the situation with President Trump and Xi Jinping. We have some stuff on that and whether or not we're going to get a trade deal. But the bigger part, I think, is how stable is the job market and will they be able to get it under control? Because if we do see more of this playing in, then we got a problem ahead of us. So I put this out, the 25 basis point, almost certain that's now happened. If you didn't hear, the Fed has already announced a quarter point basis cut on this, the second one of the year. And now, even though I still think we're extremely high on overall interest rates dropping to 3.75 to the 4 range on the median range, and then more liquidity could be Bitcoin getting a little bit of flight here, but there's some problems. And I've kind of, referred to those. Labor market is a big one. And I think this is maybe bigger than we think because all this data is still hidden because of this shutdown. So just remember, inflation is still above 2%, and then a sell the news volatility could happen. All of this, one hidden indicator from Powell could change everything for crypto. And the hidden indicator could be the labor market and also what could be coming in from what I think is going to be GDP. And I think that is a factor that we got to look forward to in terms of data coming back in. Here was a poll we put out today over on X. By the way, if you're not following us on the network account, it's Paul Barron TV, and you can kind of see it right there. But the poll is the bigger bull catalyst for today's FOMC meeting are priced in quarter. Nobody was going there, only 27. I agree. Everybody anticipated end of QT. This is the anticipation that would be very bullish for the market in general. Now, it's negative in the sense that we've lost control of possibly jobs, but for quantitative tightening to end, this would be a huge step in the right direction. So good stuff going in that. We will get into the live stream here shortly. We're going to be taking some questions today as well. If we get a chance before the live stream, I'll take a few of those. If the guys have it open, we'll make sure that it's available. And we'll, if you have some questions, we'll try to get to those as we can. So drop them down on the side. A couple of points I want to hit on right here. If you guys remember, Bitcoin dropped 6 to 8%. This is on the last 3 FOMC meetings, and it made a new all-time high before the next FOMC. So we could see a retracement, and then December could be the blow off top. Many people look at this fourth quarter, if you agree with some analysts out there, still looking at that 4-year cycle. They say this is the quarter that all this happens. And that quarter, we are right there in the middle of it as we record this at the end of October. If you're catching this in early 2026, thinking about what's going on in the crypto markets. Other things that you got to consider is how does the situation play out with China? You got Trump, of course, and Xi Jinping meeting. This was a statement that came out with the president saying satisfactory, very satisfactory. Now, I'm not sure what that means. Trump is a interesting deal maker. He kind of throws things out there and almost manifests certain things. And then you get reaction from the markets. Then you also get reaction from the people he's negotiating with. Now, what was interesting to me was this, that Xi Jinping, I love that. I love these guys. These memes are just, I mean, come on, we got to show that. That's just too good. China purchases 180,000 tons of U.S. soybeans in their first order in months. So this is showing a good faith move ahead of tomorrow's meeting between Trump and President Xi. Is it a masterstroke by Xi to try to get his way? Or does he know something? Does Xi Jinping know something and say, hey, I feel like we might have an angle here? There could be some things here that really start to bring us to neutral against the United States. and maybe we can start to work together with the United States. If Xi Jinping is thinking that way, I guarantee you Trump is ready to make a deal. And if that happens, this will be a global, monumentous move because it is going to put pressure on DC to get the government back open. It's going to put pressure on capital markets. It's going to put pressure on investors. And best of all, it's going to put pressure on some of these bad deals that are out there that will get restructured here around the United States, which means that Trump's going to have kind of a new angle for negotiation if he pulls this off with China. That will be one of the biggest deals he's done yet. Doesn't mean that he will, but it means that we could see it. The S&P 500 closed higher today. This broke 6,900. First time in history, guys. We are watching history. 398 components in the S&P closed red, though. This is a problem because now you're talking about 80% of the S&P 500 companies closed red, yet the index is still going up. So it only tells you one thing, and that is big tech is everything. We've got breaking news, I think. All right, so we've got it. Announcement from the Fed that tightening is over. Okay, we can end the show now. All right, December 1, we are going to get easing into a Fed balance sheet that is quite different than it looked quite some time ago. Remember, that was around 9 trillion. It backed off to around 6.6. If we get another 2.2 off of that, easing will start to loosen up. And you know what that means, guys? Money into the market, and this will be huge for the markets. I'm just going to go to the chart real quick just to see how Bitcoin and the markets are responding to that announcement, because it may not even be out there just yet. We're on the day. Let me drop into the 10-minute. We'll go to the 10-minute, 15-minute right there. All right, so not much movement right now. Bitcoin starting to retrace around 111. I think this is a bullish move, guys. So we may see how he represents this. Well, I'm sure he's going to address it heavily in the press conference. So stick around for that. This could get huge around some of the statements that he's talking about. If you look at Ethereum right now, up a little wildly on this move. So interesting there. Could we see Bitcoin dominance starting to move? Let me look at dominance real quick. Still ticking down over the last 24 hours. Last 24 hours. We're here on the 15-minute on Bitcoin dominance, slipping under 59%. I think this still needs to jump back down to around 54 for us to see some movement into some of these altcoins and the rotation. Solana gets a nice little pump here on some of the news, going back to 196. Let's take a look further in. XRP goes up slightly on the news, it appears. And then, of course, ETH going in there. Doge, let's see what's going on in the alt. Yeah. So market seems to respond slightly good for it, at least in the last 30 minutes or so. Let's get into some other things, because I think the notice that we've got to look at around what to prepare for in the markets are really going to boil down to a few points. And not only are we looking at the situation with the S&P, with trade, but also what we're going to be dealing with is how does the economy play into this. Now I want to go to a clip, because this is a strange economy right now. You've got the haves and the have-nots, and I think you guys know what I'm talking about. When we have an all-time high on gold, you've got all-time highs in the stock market, you've got Bitcoin well over 100K, Ethereum flirting with 4K. I mean, times are good for an investor. Times are good for an asset owner. But take a look at this clip.
First of all, it's a strange economy right now. We're talking about that GDP is quite strong, but the labor market is soft, and we're waiting to see how that will evolve. But the soft labor market is what's getting the Fed to cut, and just history shows when the Fed is easing and the economy is holding up and earnings are strong, that's some of the best returns that you get in equities. And so I think it's kind of keep it simple. This is a good environment for stocks.
Evan, when does what level does the unemployment rate become problematic for the markets? Forget about the Fed, because they're focused on it.
Yeah, I don't know that it's a particular level. It's the speed, right? And we still have a pretty low overall level of unemployment, 4.3%, we think, because we're not getting the data at this point. But if we start seeing the speed pick up, if we start seeing initial jobless claims spike, and we are at least getting the state level data there, and it doesn't look too concerning, then I think we're in okay shape.
Evan, today was a day when, in terms of asset allocation, you had equal weight to do nothing, in fact, be down. Most of the S&P was down today. And so we're at a place, just kind of curious how you're kind of advising across this big umbrella that you see and that you have to advise into. Is it to lean heavier into the stuff that's working?
I think for the most part, we're leaning into what's working. I mean, I think there are some sectors where you're seeing the earnings and they're not being rewarded to the same extent, like financials. We're overweight there, and we think we're going to get going again. But with the momentum that we're seeing in tech, I don't think you want to fight that.
All right, so a couple things to compare there. Momentum in tech. He's talking about a $5 trillion NVIDIA. We're talking about those 8 companies kind of, wagging the dog right now when it comes to the market. And then you have to look at crypto. I think the underserved market right now is risk assets, and you guys know that. Just as a reminder, and I think this is the factor that they're looking at going forward here. Just as a reminder, quantitative tightening right there ends on December 1st. This is the first time we've seen this in some time. Man, this will be an unbelievable news cycle over the next few days. You guys want to stick around for this because this could have major impetus on the market and how it starts to play out. A lot of factors that will get into this, especially around macroeconomics. Both on a global perspective, but also even with other countries. So you could see the American dollar might actually end up pushing further down on this. So that gets into the Dixie layout, which goes into risk assets. You guys understand that. Then, of course, you're talking about even precious metals that will play into this. Gold most likely will probably see a rise as well. If you're brand new to the live stream today, we have 2 good news pieces for you. One is a 1/4 basis point, another cut. That's our second cut for the year. Expect another one coming in December. I think the real question is how much? Do we get the 50 basis point? We'll go to the poly market in a minute to take a look at that. And then, of course, the other news I just announced, if you just joined, is quantitative tightening is over. That is the big news. I think we probably need to make a T-shirt on that one. Let's go over to another clip real quick. This is CNBC's talking about the market being divided. Take a look.
I think you look at this in many ways as things are going well, but we're in this, many people call it this K-shaped economy, right? We've got one leg going up and one leg going down.
When has that not been true, that there's the high-end consumer and the low-end consumer?
It's always been true.
Is it worse?
I just think it's bigger and more divided today than it has been in a very long time. Between people that are doing well and have enormous amount of disposable income and are willing to spend money no matter what's going on in the economy. And then there's those, as Becky and you were just talking about, those that literally work for the government today who are probably standing in line potentially at food banks to be able to put food on their tables. The dichotomy between the two of those is as wide as has ever been. As you point out, if you look at overall corporate earnings, they continue to be very strong. But when you look at how corporates are getting there, it's also interesting. We've seen probably more layoffs in this round of corporate earnings than we've seen in a long period of time.
Okay, so you can hear the narrative here, and I know that many of you probably are out there thinking, we've got people out there in food lines now, we've got people out there that are losing their jobs. What I'm going to say is this, is that when you look at the market the way it is, and I think this is going to be something that we're going to see more of quickly because of the acceleration into this job loss. It's going to get worse, guys. We are talking about, I think the gig economy needs to do a complete flip into building a digital asset economy. And what I mean by that, hear me out, is think of crypto as a business. All right, just like if you're an Uber driver or you're a gig worker, think of it as a business. Just start dropping small amounts into the top 10 assets out there, easy enough, even if you want to look at some of the things that are happening in the S&P. Investing in assets is the only way you beat this system. It's the only way. You're not going to beat it by earning money. Earning money is the segue into getting into digital assets or other assets that you can start to beat. And that's when you don't have the problem of dealing with job loss. You don't have the problem of dealing with food lines, all those kind of things, because it doesn't make sense for an American in today's world to be dealing with this, especially with the available information and the tools at our disposal. I don't get why we're going in that direction. And from what I hear, we do a webinar and a seminar every couple of weeks. It's getting younger and younger in terms of the business owners that I'm talking to. And they're all saying the same thing. We are going to go around the US dollar. We're going to start looking at assets and building businesses and going into assets. And that could be everything from gold, real estate, and obviously digital assets, Bitcoin, Ethereum, Solana, XRP, you name it. Everybody's looking at that as the hedge for beating out the system. And it's the only way it works, guys. It's the only way it works, because what's happening right now, actually, before we go to that, I want to go to the poll before we go into short sellers. We'll get into that. Let's go over to the poll. How will October crypto market end? Ooh, split poll. We've got a rally at 40. Neutral, I'm going to give neutral, and I have no clue, as in the middle, and then a final crash, 17%. So it looks like the rally guys are trying to win this one with almost 5,000 votes coming in. Lots of good questions coming in. Thank you for those guys. We'll try to get to a handful of those before we get rolling. As I said, if you're not subscribed to the channel, make sure and do that. If you're brand new to the live stream right now, we will be airing Chair Powell's announcement at 2:30. In 9 minutes, we will be going to Chair Powell. He will give us the reasons why he gave us a quarter basis point. He will give us the reasons of why he is going into quantitative easing. And he will give the reason why the economy is in deep shit. So hopefully, because I think that's where we are right now. And if you look at this right here, this is interesting because it gets into the trading mentality of what's happening out there. Short sellers are on track for their worst year since 2020, and they're blaming retail investors for acting irrationally. They're acting irrationally. You guys are acting irrationally out there. You're actually taking advantage of the market because finally you get to beat the man. And that's the beautiful thing about crypto, is you get to beat the man. And I totally agree with that. Sometimes I think I'm a libertarian because I am all for the people to beat the man. NVIDIA, of course, officially the first $5 trillion company. I know that's, the rich getting richer, but this may put more pressure on the economy than anything. And what I mean by that is when you have a company that is leading the S&P 500 at the scale in which NVIDIA is leading it, which is unheralded before, this narrative only points in one direction, and that is a direction, and I think it's already starting to play out in the early times of where I showed you guys in the first of the show, is these job losses. This narrative, I think, plays out much greater in these jobs losses that are coming. 2026 could be a very bloody year for jobs, and possibly a bloody year for earnings on a lot of companies that are going to be looking for answers, because retail may not necessarily come back into that. The only way, again, to beat this is to get into digital assets. Any kind of asset that can go up versus the value of your dollar going down. That's the problem that we're dealing with right now. And with AI all being played into almost every walk of life, and it's accelerating, guys. It's accelerating so fast that you need to pay attention to what's happening out there. I don't know if you caught our X402 video this week. It's the big red thumb on our YouTube channel. Go back and watch that. We had the Coinbase team, one of the 3 developers that basically took a technology that was created during the era in which I was an engineer at Microsoft, 1996. And it was a technology that was built on the infrastructure of HTTP and the very backbone of the internet that is now going to create payment architecture for agentic payment infrastructure. I want you to think about that for a second. Go watch that video because it's good. You'll understand what I'm talking about in terms of where this is going and why this really shifts a lot of narratives going forward. Speaking of my old boss, Mr. Bill Gates, he said that the commitment phase of the AI revolution is here. Take a look.
Do you look at all of the investments that are being made today by some of the big tech companies, some companies who are not making money on AI yet, but are making massive commitments to chip makers and data centers, and say this math makes sense?
The AI is the biggest technical thing ever in my lifetime. I mean, it is so profound, and therefore its influence is hard to overstate. And the economic value, this is basically intelligence. where you can get medical advice, or you can get a tutor, or you can get somebody to help you design drugs. So the value is extremely high. Just like creating the internet ended up being, in net, very, very valuable. But you have a frenzy, and some of these companies will be glad they spent all this money. Some of them, they'll commit to data centers whose electricity is too expensive, right, that it could be done overseas, or they'll buy a generation of chips and they won't have captured all their value before the next one comes along.
All right, so Gates is on it. I mean, listen, the old dog still has a few tricks, I think. He understands the impact that's going to play out here. And I think, he missed, I don't know if you guys know this story, but Gates missed the internet. He was our CEO at the time at Microsoft, and we were in a position where we were controlling the market. The internet came along, Netscape was pretty much kicking our, we came in, played dirty pool, put Explorer into everything, and the rest is history. But the point being is that Microsoft was not on the front line of the internet, and I think a lot of companies are going to be looking at AI the same way. They don't want to be caught with their shorts down in the sense of they weren't ready, and that's, I think, going to affect a lot more companies than just tech companies. It's going to affect companies like we just showed there in the beginning of the show: Nestle, Amazon, Target, all these different retail integrations that are going to play into this. The gig economy, I think, is going to eventually be cannibalized dramatically. Obviously, we'll see that playing out, I think, with self-driving that will probably attack Uber in a big way. But it's also going to attack the gig work economy. And that, again, goes back to my whole thesis is investing is the only. That's your new gig job, guys. Crypto is a business. You should treat it that way and look at it that way. Do the research, get out there like a side hustle, and get going. Bitcoin ping-ponging price action could happen. The question is whether or not this will wrap up around one last key piece on the board, and that is U.S. versus China. So when you look at the gambit that is being played right now, which is being played right now, this could be one of the biggest chess moves that really do put the United States in a good position, possibly into a parity. I won't say that the China is at a parity, but when you look at the global economy, these two are the titans that I think are going to either one control. And you have to look at China. China has gone the route of gold possibly as a reserve. The U.S. is going the route of stable coins possibly as a reserve against the treasuries. When you compare that in the two global economies, this is where everything starts to come together, and that's why digital assets will continue to be a big factor here. Bitcoin, of course, will lead the way. 13%, rising 13% since its historic liquidation event, which was, as we all know, some nefarious situations there. But that happened October 10th. Charts now indicate that the daily closes above 116 are needed to lock this bull reversal in. And I want to know, do you guys think we are in a bull reversal, or do you think Bitcoin dominance could have topped out here? That is the real question, because this could mean a rotation into altcoins. I know everybody's saying that the elusive altcoin season, is it going to happen, Paul? Is it going to happen? I get that out there so much. I think the question is how does the narrative come in from Wall Street? Because that's the narrative, unfortunately, guys, that we're playing with. And you got to watch the things that are happening on Wall Street. One of them is Nate Garossi kind of hitting on it right here. Bitwise's spot ETF for Solana posts the highest one-day trading of 850 ETF launches this year. So who could have saw that coming? So there you go. And we still have spot XRP ETFs that will likely see a similar reception, if not greater, according to Garossi. So what does that tell you guys? If you have that kind of appetite for altcoins and secondary assets, and when I say secondary assets, outside of Bitcoin, outside of Ethereum, you've got XRP, Solana, and really just a handful of others. And that's what we're dealing with right now. And congrats to a lot of the ETFs. Litecoin went live this week. Hedera went live. So HBAR community, I know you guys are out there. A lot of good things. We will get to some questions. Looks like they're starting to queue up for Chair Powell as he gets into this. Well, let's not leave Ethereum out of the conversation today, because BitMine and the ETH-tarded have decided to go back in and buy more. Here is Chair Powell. Let's go to the live.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet, and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire. I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just...
All right, guys, we're going to continue this coverage. Make sure and get the poll. We want to get your feedback on that. And hit the like on the video if you have not already. Do you like these FOMC meetings? Let me know.
Both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when participants go out and talk, they're very disparate views. And they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars because, again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby.
Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state-level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings, suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So, we get, like I mentioned, what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the beige book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had 2 dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop it, the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what. In the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities. And we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding Treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services, and we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths, and so that if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further. But it is that it will be a one-time increase. And, we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because, the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles. How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world, and big U.S. companies are just investing a lot of resources in thinking about how AI which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about a continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys of the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully, and yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are, if you listen to the earnings calls or the reports of big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that. And so we think there's something there.
Edward.
Thank you. Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, you said far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then?
Well, the perspectives of people on the committee that, we've now moved 150 basis points, and that we're down into, you're into that range between 3 and 4, where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth, that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there's a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
And so on that division then you're talking about going forward, so what's more important in this division? Is it inflation risks, is it employment risk, or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have in fact cut 2 more times. And we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth.
Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing. And then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and so the unemployment rate has gone down, meaning that demand for workers is going down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to 0. So maximum employment doesn't, on a sustainable basis, doesn't, if you're creating zero jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last two meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools. But others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory, this is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level. And then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael Pickey from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable and whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about, it's not about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring. And that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why the pace we're going has been a careful one.
Victoria.
Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that and has been growing and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher-end consumers, or maybe skewed that way. But the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than AI. You could point to growth. I mean, actually, growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs because there isn't this flow into the pool of labor that where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown, and of course that will reverse. But you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I mean, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed. But you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to. I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian.
Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market?
All right, guys, it looks like
accelerating?
we're going to wrap on this because Powell normally does these for about 30 minutes. He seems to just be moving on further on Q&A. But really what it boils down to is tightening has stopped. That was the big narrative for today. This will begin, or will stop on December 1st. And the question is does easing start to play into this? Remember how the Fed goes into quantitative easing, typically to correct market uncertainty, which may play into this toward the end of the year. And again, a lot of this could be coming in from these job losses. Again, data still not in front of Chair Powell and the Fed governors. One note that is interesting right here, let me go to a couple of points because it is a growing divide at the Fed right now. And in terms of the next potential FOMC, one, of course, dissented. We had one governor dissent for no cut now. That one did not happen. And then one dissented for a favor of 50 basis points in terms of a cut. So clearly a divide. And if you look at poly market right now, the position is still holding around 69%, with a 28% up considerably for no change in December. All this gets very intriguing on how this plays out between now and December. So let me know in the comments, do you like these live streams? If you do, let us know. Give us some comments down there. And of course, if you're not subscribed, come on guys, get in there, subscribe to the channel, hit that little bell. You'll get notified when we do these live streams like this. We'll do more for you if that's what you guys would like. Get in on the Diamond Circle. It's our own private group that you can join for free. We always leave a link down below. We'll catch you next time right here on The Paul Barron Show. Take care.